What if I told you that some of Wall Street's most innovative growth companies are currently trading at significant discounts, poised for massive rebounds? We're talking about industry leaders integrating cutting-edge AI, dominating their markets, and sitting on piles of cash, yet the market has completely overlooked their true potential. In the next few minutes, I'm going to reveal 5 such stocks, each with a compelling case for substantial upside. Stay tuned, because unlocking these hidden gems could redefine your portfolio's future. First up, we have Adobe Systems Incorporated, ticker ADBE, a global software giant synonymous with creativity, marketing, and document management. In Q3 2025, Adobe posted impressive revenue of $5.99 billion, a 10% year-over-year jump, with non-generally accepted accounting principles EPS hitting 5.31, up 14% year-over-year. Both figures handily surpassed analyst expectations, prompting the company to raise its full fiscal year 2025 revenue forecast to an impressive $23.65 billion to $23.70 billion. Adobe's strategic integration of artificial intelligence is truly paying off. Their AI-influenced annualized recurring revenue, or ARR, has now soared past $5 billion, a significant leap from $3.5 billion just at the end of fiscal year 2024. This achievement already exceeds their full-year AI-first ending ARR target, showcasing successful monetization of their AI innovations through offerings like Adobe Firefly, Gen Studio, and the Acrobat AI Assistant. These tools are rapidly gaining traction with both creative professionals and large enterprises. In fact, 99% of Fortune 100 companies are already leveraging AI features within Adobe applications. On the operational front, the company boasts remarkable gross profit margins of 89%, indicating a highly efficient and profitable business model. Its subscription-based revenue, accounting for 96% of total revenue, provides stability and predictability, with digital media ARR growing 11.7% year-over-year to $18.59 billion. Management is also aggressively buying back shares, and 25 analysts have revised their earnings upwards, reinforcing confidence. While Adobe's $20 billion acquisition of Figma was terminated due to regulatory concerns and competition from alternatives like Canva presents a challenge, the company is trading at an attractive forward PE of 16.15 compared to its near-term earnings growth, with a fair value estimate of 455.08 against its current price of 324.47. Analysts see a potential 44% upside, making Adobe a compelling undervalued growth play. Next on our list is Carlyle Companies, ticker CSL, a name that is a deeply entrenched leader in building envelope products and solutions, primarily for the construction industry. Carlyle has carved out a robust niche as a pure-play building products enterprise, with a strong focus on commercial roofing and building envelope solutions through its Carlyle Construction Materials and Carlyle Weatherproofing Technologies divisions. What makes Carlyle Companies particularly resilient is its core commercial re-roofing business, which alone accounts for roughly 70% of CCM's commercial roofing revenue. While Carlyle's Q2 2025 performance saw flat year-over-year revenue at $1.4 billion and a slight miss on EPS at 6.27, the company's financial foundation remains exceptionally strong. They've consistently generated over $1 billion in free cash flow annually for 4 consecutive years, a testament to their operational efficiency. Carlyle is not just resting on past successes. Its ambitious Vision 2030 strategic plan aims to more than double adjusted EPS to over $40 and achieve cumulative free cash flow exceeding $6 billion by the end of the decade. The company is deeply committed to shareholder returns, evident in its impressive 32-year consecutive dividend growth streak and $343 million returned to shareholders in Q2 2025 alone through dividends and share repurchases. Despite facing softness in new construction due to higher interest rates and economic uncertainty, Carlyle is actively mitigating risks through cost reduction initiatives and strategic acquisitions like Bonded Logic, enhancing its sustainable building product offerings. Analysts see a 25% upside to their target of $369.50. With robust cash flow, a long history of profitability, and a clear growth strategy, Carlyle Companies is an undervalued industrial powerhouse poised for long-term appreciation. Moving on to Deckers Outdoor Corporation, ticker DECK. This global leader in premium footwear, apparel, and accessories boasts an enviable portfolio, spearheaded by its incredibly popular HOKA, and UGG brands. Deckers recently delivered a phenomenal fiscal Q1 2026 performance, showcasing remarkable resilience and brand strength. Revenue surged 17% to $965 million, and earnings per share jumped a remarkable 24% to $0.93, significantly exceeding analyst expectations. This growth was largely propelled by HOKA, which contributed $653 million, a 20% increase year-over-year, and UGG, which delivered $265 million, up 19%. International markets proved particularly robust, with a stunning 50% revenue growth, helping to offset some of the challenges in the U.S. consumer environment. Deckers' financial health is rock solid, with a robust balance sheet featuring $1.7 billion in cash and absolutely no outstanding borrowings as of June 2025. This exceptional liquidity provides a strong buffer against market fluctuations and fuels strategic investments. The company is also actively returning value to shareholders, having repurchased approximately $183 million worth of shares in Q1 alone, with a substantial $2.4 billion remaining under its current authorization. While Deckers does face some headwinds, including an estimated $185 million in potential tariff impacts for fiscal year 2026, and a slowdown in U.S. direct-to-consumer growth, particularly for HOKA, management is proactively implementing selective price increases and strategically expanding its wholesale presence to navigate these challenges. Trading at a low P/E ratio relative to its impressive near-term earnings growth, and with analysts targeting a median of $111.97, implying a 35% upside from its current price of $83.77. Deckers Outdoor presents a compelling case as an undervalued growth stock. It holds more cash than debt, and cash flows sufficiently cover interest payments, underscoring its financial stability and potential for continued market dominance. Our fourth undervalued gem is FactSet Research Systems Incorporated, ticker FDS, a critical provider of integrated financial information and analytical applications to the global investment community. Despite its essential role, FactSet stock has faced significant pressure recently, declining approximately 39% year-to-date and currently trading near its 52-week lows around $272.11. This downturn presents a unique opportunity, especially considering the company's consistent revenue growth, with fiscal 2025 revenue increasing 5.4% to $2.3 billion, and organic annual subscription value growth accelerating to 5.7% in Q4 2025. FactSet's Q4 2025 results were a mixed bag, with revenue beating expectations at $597 million but adjusted EPS of $4.05 missing forecasts. The core challenge and opportunity lies in the disruption from artificial intelligence. Approximately 75% of FactSet's revenue comes from workflow solutions that could be vulnerable to AI. But new CEO Sanket Vishwanathan is proactively repositioning FactSet to become the leading AI-powered financial intelligence platform. The company has already launched 6 AI-powered offerings, which contributed significantly to ASV growth in FY25, with 60% of AI-related sales occurring in Q4 alone. FactSet projects FY26 revenue between $2.42 billion and $2.45 billion. While this involves some margin compression as they invest heavily in AI, data expansion, and infrastructure, it's a strategic move for long-term dominance. Despite the stock's recent hit, FactSet maintains a strong financial foundation with over $600 million in free cash flow and an impressive 26-year dividend growth streak. Its current RSI suggests it's in oversold territory, making it an attractive entry point for investors. With analysts projecting a 42% upside to their targets, FactSet represents a compelling deep value play for those betting on the transformative power of AI in financial services. Finally, we have Gartner Inc., ticker IT, a powerhouse in research and advisory services that operates globally. Despite its strong market position and essential services to enterprise clients, Gartner's stock has been inexplicably punished by the market, hovering near its 52-week low at $226.32, a staggering 56.3% down over the past year. This massive sell-off creates a compelling opportunity, especially given the company's recent robust performance. In Q3 2025, Gartner blew past EPS expectations by 13.58% at $2.76, with revenue reaching $1.5 billion, a solid 3% year-over-year growth. This beat immediately sent the stock up 2.87% in pre-market trading, indicating a turning tide. They recently launched Ask Gartner, an AI-driven tool designed to enhance their product offerings, with CEO Gene Hall emphasizing AI as one of the most innovative and pervasive technologies in history. This strategic integration is not just talk. Gartner has raised its full-year guidance to at least $6.475 billion in revenue and $1.575 billion in EBITDA, projecting contract value growth to re-accelerate to high single digits in 2026. While the company does face challenges like longer sales cycles and exposure to tariff-affected industries, its strong operational execution and effective cost management strategies have allowed it to maintain healthy profitability. Management has also been aggressively buying back shares, and 10 analysts have revised their earnings upwards for the upcoming period, with analysts projecting a 39% upside to their mean target of $284.27, and the stock trading at a low PE ratio relative to its near-term earnings growth. Gartner stands out as a significantly undervalued growth stock. Its current valuation implies a strong free cash flow yield, making it an attractive prospect for long-term investors looking to capitalize on market irrationality and a clear path to recovery. Now let's line up the data side by side and truly understand what makes these 5 stocks so compelling right now. Looking at the current prices, we have Deckers at a modest $83.77, FactSet and Carlyle both over $270 and $300 respectively, and Adobe leading at $324.47. Market capitalization also tells a diverse story. Adobe is at $135.8 billion, while Deckers, FactSet, and Gartner hover around the $10 billion to $16 billion range, offering more agility. When we examine revenue, Adobe again stands out with a massive $23.181 billion, followed by Gartner at $6.46 billion, and Deckers at $5.244 billion. Carlyle and FactSet are substantial players in their own right, with revenues of $5.015 billion and $2.322 billion, respectively. Now, let's talk profitability with gross margins. Adobe takes the crown with an astounding 89.1%, showcasing incredible efficiency in its software business. Gartner follows strong at 68.2%, and Deckers impresses at 57.7%. FactSet's 52.7% and Carlyle's 36.2% are also respectable, demonstrating healthy core operations. For income investors, only Carlyle and FactSet offer dividends, yielding 1.5% and 1.6% respectively, signaling their maturity and commitment to shareholder returns. The others are reinvesting their profits back into aggressive growth. Finally, earnings per share. Carlyle leads with a strong $17.64 EPS, closely followed by FactSet at $15.74 and Adobe at $16.09. Gartner and Deckers also show solid profitability with EPS of $11.54 and $6.77. What this table reveals is a group of fundamentally strong companies, each excelling in profitability and revenue generation within their sectors, currently trading at prices that don't fully reflect their underlying value and future growth potential. So these are 5 undervalued growth stocks with massive upside ahead. They represent a unique opportunity for investors looking beyond the headlines. Which of these 5 undervalued growth stocks do you think has the strongest potential for a breakout? Or do you have another undervalued gem that you're watching closely? Drop your thoughts and predictions in the comments section below. And don't miss our video right here on 7 best AI stocks to buy, according to hedge funds. Thanks for watching, and I'll see you in the next video.